when it comes to planning, if you are close to retirement and you're really thinking about planning, what you're probably really thinking in your mind is your cash flow. That, how much once I retire, how much income I have coming in and how much spending, I outflow do I have, right?
How much will you need to pay for healthcare in retirement? Well, a number of institutions have published estimates over the past 2 decades plus that have likely frightened you into a state of fear and maybe even inertia. Consider the Employee Benefit Research Institute has shown that a 65-year-old couple needs $350,000 to have a 90% chance of covering all healthcare expenses in retirement, and that doesn't include long term care. How in the world will you pay for all that healthcare? Well, here to help me decode all that is Sudipto Banerjee. He is a global retirement strategist at Rowe Price. Sudipto, welcome.
Thank you. Thank you for having me.
It's a pleasure. We're old friends, and I know the tale well, but I want to start here with the EBRI numbers, which is a research institution, a nonpartisan one, I should add, that you once worked at, where we showed, and you showed, perhaps maybe Paul Fronston and others showed that a 65-year-old couple needs $350,000 to pay for healthcare in retirement. And for someone who might be listening, maybe they're in their 50s or 60s or so, that's a big number. And thinking, I don't even have that in maybe I have that in my 401k, in my IRA, but what am I going to use for living expenses?
Yeah, yeah. So, my first point there would be not to really focus on that number, that one single number that you mentioned, whatever, $350,000. But really to understand that, it's one way of looking at healthcare costs. It's what a couple will spend over 30 years, right? It's just the sum of that. But when it comes to planning, if you are close to retirement and you're really thinking about planning, what you're probably really thinking in your mind is your cash flow. That, how much once I retire, how much income I have coming in and how much spending, I outflow do I have, right? And for that, of course, you need to figure out your income side, and then you are looking at your spending side. And right there's one big element, which is healthcare, right? So I think that's where people should focus on, that, doing the cash flow analysis, and which means asking how much am I going to spend on healthcare on an annual basis, right? And then, the all the other elements, that, housing, food, etc., right? And then how that matches up with how much income are you expecting, whether there's a mismatch or not, then go from there, right? But to focus on that one single number, I think it does not help as much with planning, because, healthcare is not something that you retire, a day, then you got a check of $350,000 to someone and healthcare is taken care of. It doesn't work like that. It's an ongoing process. Every year you have to make decisions. So I would say that focus on that cash flow and the annual number. So we have done a lot of research, as you mentioned, where we provide, a lot of different numbers, but looking from that annual, point of view. So I would say, maybe start there.
Yeah, I mean, this is just rough back of the napkin. I'm not going to do a present value of that per se, but if I take a look at, let's call it 300,000 for a couple age 65 over 30 years, I'm looking at what is that? Maybe $10,000 per couple or $5,000 per person over the course of 30 years, which seems like a much more manageable expense given that you might have cash flow and you might have assets to pay for this and you might have Social Security benefits to pay for this. I know we're going to dive deeper into that. But before we do, Sudoku, I want to talk a little bit about Medicare Advantage versus Medigap, traditional Medicare, and what your research has shown around what might be a better way to manage healthcare costs as you think about removing the risks that you might face, or the unplanned for costs, let's say.
Yeah, yeah. It's a really important decision. I think, when it comes to healthcare and retirement, that's a choice of the plan. Exactly what plan you choose, whether you go with traditional Medicare, whether you go, a Medicare Advantage, or you add a Medigap. I think that's a really important decision. So people should pay a lot of attention to that. But particularly when it comes to the choice of whether you want to add Medigap policy, with your traditional Medicare or not. I think there's two questions really to answer here. So the first one is, can you afford it? Right. Because as you might have seen from the research that we have published and others have done similar work that, Medigap on average, it costs more, annually, maybe around $2,000 more. Right. So there is a question of affordability, right? Can you afford that additional, $2,000 or so? If you can, that's great. Right. So that then the next question then becomes is basically why do you want Medigap? Basically, right. So usually the reason that people want to add Medigap, to their coverage is to limit their out-of-pocket expenses, right? Because with traditional Medicare, you have the deductibles, you have the co-insurance and all that. Once you add Medigap to that, you're thinking that my out-of-pocket expenses, are they will be checked. But when we did the research, when we look at the numbers, so on average, people who have Medigap, they are spending their out-of-pocket spending is similar to people who have other types of coverage. It's not less. It's only at the extreme end where you see that people who have Medigap, they have lower numbers. And the reason for that is basically people who have Medigap, they just use more healthcare because they know they have that protection. They just use more healthcare. So when people are thinking about this, I just want to make sure that they understand that the expectation, if they have the expectation that, I will have lower out of pocket expenses, that might not happen because what we see is people just end up using more healthcare.
Yeah. I should mention too that this is almost a irreversible decision. If you decide to go with Medicare Advantage when you sign up for Medicare, and you should become unhealthy over the course of retirement, trying to switch from Medicare Advantage to original Medicare with a Medigap policy is probably virtually impossible. So you need to think
Right,
about
right.
the 5, 10, 15 years into your retirement and make that decision not based on today, but perhaps on what the future may hold. And though you may pay more for Medigap now in the present, maybe you'll pay less over the course of your retirement for healthcare because you won't be exposed to those large out-of-pocket costs that you might face with a Medicare Advantage plan, for instance, should you become
Right.
unhealthy.
You are right. And yeah, it's personal decision. People know they have their own medical histories and all that. So based on that, you may need to make a decision. But you're absolutely right. Yeah. So you have to aware of that. The down the line, it might be an irreversible decision. Yep.
There's another sort of healthcare decision that people need to think about, but maybe in their 30s, 40s, and 50s, which is if they have an HSA available to them in their employer through a high deductible health plan, they have an opportunity to take advantage of a triple tax-free account that in some ways offers more advantages than, say, a 401k.
Yep. Yeah. Yeah.
So what do they need to know?
Yeah, I mean, I don't know that, if all your, listeners are aware of the triple tax advantage of HSA, assuming they are, it is really unique because there is no other place where the money is basically virtually never taxed, so the contributions are not taxed, the growth is not taxed, and the distributions, of course, they have to be like eligible, for healthcare purposes. So then they're not taxed either. Um, so when it comes to HSAs, again, I think how to maximize the value of HSA. I think there is a theoretical answer and there is sort of a practical answer to it. So the theoretical answer is that I would say yes, maximize your HSA contributions, right? So there is a contribution limit.
And
So
would you do
just
that, Sudipto? Would you do that before your pre-tax 401k? Like, in terms of sequencing your contribution, would it be HSA
Oh
first
no,
and then?
the 401k comes first because with the
Yeah,
401k, if you have match, right, that's an instant, like, whatever percent your employer is matching, that's an instant return on your contributions, right? So that comes
right.
first. But once you sort of maximize your 401k match and all that, right? At that point, it might make sense to put all your money up to the contribution limits into your HSA, but there are caveats to that. So, so one is that the value of HSA is really if you keep it invested over the long term, right? So then let the money grow, and then you take the money out in retirement, right? So then you get all the tax advantages, right? But if you're putting in the money in an HSA and taking the money out whenever you need, for healthcare purposes, then you are not using it correctly. And so in that case, you might be better off putting the money in somewhere else, right? Um, so if the other part is you mentioned that high deductible. So HSAs are attached with high deductible plans. So to keep the money invested, they have to meet those high deductibles, right? Which might not be possible for everyone, right? So for the practical answer to me seems like yes, put money into your HSA as much as you can, but try to keep it invested so that if you need money for healthcare purposes, you try to get the money from somewhere else. So then whatever money you are keeping in your HSA, you're actually taking the advantage of the growth and the tax advantage as well. Yeah.
Sudipto, we have to take a short break, but when we come back, I want to talk about long-term care, which I mentioned at the start of the program, but it's a really important topic that people worry about. So don't go away. Welcome back to Decoding Retirement. I'm speaking with Sudipto Banerjee. He is the global retirement strategist at Rowe Price. Sudipto, I said that we were going to talk about long-term care costs, but the first thing I want to talk about is, since we were just talking about investing your HSA, I want to talk a little bit about investing where the research has traditionally shown that you should allocate your assets based on your age, that you would take 100 minus your age, and that would be the percent allocations that you would split between stocks and bonds. But you have a contrary point of view?
Not contrary. So we actually just published some new research just this week, and it's using data from our 401k record keeping business, and we work with some academics from MIT and Stanford. But the interesting finding was that so we try to estimate their preferences, like their equity allocation preferences and how that changes with age, and we also track their actual how they manage their allocations. So when we looked at preferences, so at younger ages, the preferences are pretty similar. Like, it's pretty homogeneous for everyone, and they all want to be highly invested in equities, which makes sense. People have very little money, they want to grow their portfolio. They all want to be highly invested in equities. But when we look at the older, groups, 50 and above, we see there is a lot more heterogeneity in their allocation preferences. So some people don't want to be in equities at all. Some people want to be, fully invested in equities. And there are a lot of people, in middle, somewhere, most people are in that 60 to 80% range in that age group. So that tells us that, there needs to be more personalized solutions, as people get closer to retirement. And when we track what they're actually doing with their money in their 401k, the interesting finding was that, as people get older, they are more actively making changes to their to their 401k, which makes sense, right? But the more interesting part was that the older they're getting, we see more and more of them making their portfolios more aggressive. So they have a higher equity allocation. They're moving towards a higher equity allocation. So that itself very interesting. And we did not really dive into the reason why people are, choosing higher equity allocation at older ages. We have some theories, like, it could be that just trying to catch up, they are, lagging behind. There are also some research which suggests that as people get older, they are more, they gain more investing knowledge, their risk preferences, they might be more tolerant of risk and things like that. But that's, for our future research. But this is what we found, that, people at older ages, basically, there's a lot of, variation. So that's our point.
Yeah.
The point I'm trying to make is that more personalized solutions probably make sense at that age.
Yeah. I mean, it sounds like the actionable advice in this case would be to at least not do this willy-nilly arbitrarily, but to know why you're becoming more aggressive with your asset allocation, and not just sort of flip a coin and say, I'm going to invest more in whatever international equities this day because my neighbor has, or whatever the case may be. All right, so I promised we would talk
Right.
about long-term care, which is the it's the one thing that many people worry about, right? They think that they will face some sort of tragedy at some point, and they'll end up in a nursing home. They don't know how they'll pay for it. They don't know whether they should buy a long-term care insurance policy. They don't know the degree to which they could self-fund it, whether their home equity is a break glass option. They talk about qualifying for Medicaid to pay for long-term care. But your research seems to suggest that it's a very idiosyncratic risk that, in the main, not that many people will need long-term care. So, but to me, I don't know if I'm going to be in the 3% or the 97%, right?
Yeah, so it's a tough decision, honestly, because what this is a classic example of what we call tail risk. That for most people, if you look at the average, people don't spend anything on long term care out of pocket, right? But a very small percentage, will spend a large amount, right? And this is sort of a classic case where you think that it's for insurance, right? It's a situation to be addressed by insurance because it's a tail risk. But as you know very well, that the long term care insurance market has not uh, perform or function very well over the years. They're having a lot of problems, and the least of which is that the policies are very expensive. So people they don't want to be um spending so much on these policies and never needing the care. So that's the uncertainty of it. In terms of how to think about whether you get insurance, whether you self fund, I think so for some people it's an easy decision, like if it's even lower end of the income spectrum, so that most of you don't have a lot of liquid assets, most of your income is coming from social security, you go with Medicaid, right? You're on the opposite end with the higher end, you're probably able to self fund yourself. It's people in the middle who you really have to think about it, whether they want to protect their assets from Medicaid or not. I think it's a tough decision. There's no like rule what they should do, but I think we can provide some guidelines as to if you are thinking about getting long-term care insurance, or if you're seriously thinking about long-term care insurance, what things you should have in mind. So my colleagues, at Rowe Price, they have done an excellent job. They have produced a very good guide on long-term care insurance. If your listeners are interested, I would highly direct it towards that. But some of the key takeaways is when is the right period to get a long-term care insurance? Because the trick is you don't want to be too late when you have health issues crop up and your premiums will really go up, and you don't want to get it too early when you are spending your premium you're spending on premiums for a long period. So I think somewhere between 55 and 65 is a good period to consider long-term care insurance. And then the other one is really to figure out, what's your living situation going to be. If you know that, if you think that, I'm going to be at home and then I'm going to move into a continuing care, right? So then it's easier to get the type of insurance that you want, because there are some umbrella policies which would cover, almost any living arrangement, and those are more expensive. But you have more targeted, if you have figured out your living situation and you get a more targeted policy, then your cost might be lower. So there are all these different things, and there are benefit limits and all that. So keep all that in mind to do your research, basically. Yeah.
Yeah. I want to save time to talk about your years in college as a Buckeye, Sudipto. But first, I want to double back on a topic that we began with in terms of paying for healthcare expenses over the course of retirement. In your research, correct me if I'm wrong, you've shown that for expected costs, your Medicare Part B, your Medicare Advantage, your Part D premiums, whatever those may be, that you would pay for those perhaps out of cash flow as you go through retirement. But for other expenses, out of pocket deductibles, copays, et cetera, that you might use a different bucket of money. Is that fair to say?
Yeah, yeah, exactly. So the way I mean, we talk about it is, you think of premiums and your out of pocket as two separate elements. So premiums, the reason is that premiums are basically, they're predictable, they're fixed. Even the year to year changes are minimal. So you have a very good idea how much you are going to need for your health insurance premiums, right? So you can basically build that into your cash flow, into your income flow, right? The more trickier part is the out of pocket expenses, where you might not know exactly how much you will need. Something might happen in some years. So the idea is that you keep sort of a cash reserve for that, and we have shared numbers based on your age and whatever, how much you might expect. So you keep whatever you are comfortable with, $5,000, $10,000, you keep that as a reserve. You spend that at the end of the year, you fill that up, again, and start the new year. So that's how we think about it. Yeah.
Yeah, I should remind our listeners that they can go to the Rowe Price website where you have at least 3, if not more, research papers that sort of hand walk people how to approach this paying for healthcare in retirement. So, and they're quite good. We can only do a sort of a shallow dive here today, Sudipto. So I said I wanted to talk about your college years. You wrote plays, you directed plays in college as a Buckeye, and I'm curious, what parallels do you see between maybe writing and directing plays and your role today now as a retirement strategist?
That's a difficult connection, but I gave up on that dream long time ago because I just realized it's really hard to make a career, in creative arts. But I do see one connection, which is really writing, because I like to write, and what that has stayed with me over the years, and uh, I value the skill of writing now more and more, because when I'm writing about all these research papers or anything like that, I think you get a clarity of thought when you are writing something. So in that ways, I sort of envy journalists like you who get to write on a more daily basis. Um, but I think that has stayed with me, and that has helped me, because I still like to spend some time, it doesn't happen every day, but write some of these thoughts, because that really helps me even think about the research itself. Yeah.
Yeah. I forget exactly whose quote this is, but they said something to this effect, that writing is easy. I just wait till beads of blood form on my forehead and then the words spill out. Sudipto, I'm afraid we've run out of time. 23 minutes goes by in the blink of an eye, but thank you ever so much for talking with us and sharing your knowledge and wisdom. We'll have you back on a future episode to talk about things we didn't get to today. So thank you.
Yeah, absolutely. And thank you for having me. It was an absolute pleasure. And look forward to staying in touch. Thank you.
So that wraps up this episode of Decoding Retirement. We hope we provided you with some actionable advice to help you plan for or live in retirement. If you have questions about money or retirement, you can email me at yfpodcast@yahoo.com, and I'll answer your questions in a future episode. And lastly, remember, you can listen and subscribe to Decoding Retirement wherever you find your favorite podcasts.
This content was not intended to be financial advice and should not be used as a substitute for professional financial services.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.